Have you ever felt that the stock market has a hidden camera inside your living room? The second you finally build up the courage to buy a stock, the price instantly drops off a cliff. And the second you get terrified, panic and sell, dump your position just to save what's money is left in your account, the chart magically turns around, rockets straight up to the sky. You aren't cursed, my friend, and you aren't just unlucky. You are playing a game against engineered system. Wall Street doesn't make its billions of dollars by predicting the future with a little crystal ball. They make their billions by manipulating human psychology. The entire financial market runs on a predictable four-phase cycle designed with one single purpose: to trick the uniformed retail investors into handing over their hard-earned money directly to institutional smart money. Think of it like a massive financial conveyor belt. Once you learn how to spot the four phases of this belt, you'll stop being an unsuspecting victim and you'll start positioning yourself like a bull. Let's dismantle this cycle step by step. Phase one is called accumulation. Imagine walking up to a high-end luxury store. It's got a torrential rainstorm going on. The news anchors are outside screaming, "Hey, the building's falling apart. The brand is ruined and the business is going bankrupt." Scared shoppers are going to be running out the front doors, dropping their expensive designer jackets and Rolex watches onto the wet pavement just to get away from this. While that crowd runs, a small group of calm, disciplined investors walks up quietly from the back alley. They pick up those pristine designer goods off the floor for 10 cents on the dollar, fill up their trunks, and drive away smiling. That, my friend, is accumulation. It happens at the absolute bottom of a market crash. The media is broadcasting doom and gloom. Headlines are screaming about recessions and financial collapse, and the average retail investor is exhausted, bleeding money, emotionally broken. They throw in the towel, panic sell all their high quality shares for just pennies on the dollar, just to stop the pain. Who's buying those discounted shares, you say? The institutions. While their public panics, smart money silently accumulates massive positions in great companies at dirt cheap prices. They don't just make noise, they stack up assets. Once the institutions have locked up almost all the available shares at rock bottom prices, they trigger phase two, the markup. Think of it like a ticket scalper at a sold out stadium concert. The scalper buys up all the $20 tickets when nobody's paying attention. Then he hires a hype team to stand outside the arena shouting that this is the greatest show in human history. Suddenly, everyone wants a ticket. The scalper starts selling those $20 tickets to desperate fans just wanting to get in to see the show for $200 each, then $1,000 each. During the markup phase, institutions stop buying and let the price rise. As the charts climb to green days after days, the financial news flips the narrative overnight. Suddenly, pundits are like talking about this historic bull runs and record profits. Social media explodes with gurus flexing their quick gains, and the retail trader who sold at rock bottom looks at those soaring charts gets hit with massive FOMO, fear of missing out, and they lose their mind. They can't stand watching everyone else get rich. So what do? They take their life savings, rush back into the market, and buy heavily, right at the absolute peak. They think they're getting into it on the ground floor, but in reality, they're standing on the roof. Now, this brings us directly into phase three, distribution. Picture a lavish VIP party. The music is blasting, champagne is pouring, and everyone is out celebrating. The retail crowd just arrived at the party, completely intoxicated by the hype, buying up assets at astronomical prices. While the retail crowd is dancing and cheering, the hosts of the party, the smart money, are quietly putting on their coats and slipping out the back door. They are selling their massive positions directly to those hyped up retail buyers, locking in thousands of percents in profit. And the retail market thinks they're buying the future. In reality, they're just holding the bag. Once the institutions have sold off all their shares at top, we enter phase 4, the markdown. With no more institutional money holding up the market, the buying pressure completely vanishes. The price breaks through key support levels and plunges downward like an elevator with snapped cables. Panic floods the market. The exact same retail traders who bought at the top of the greed now sell at the bottom of their terror. They dump their positions at a massive loss right back into the institutions. The cycle resets. Smart money gets richer, retail gets wiped out, and the game repeats. So, how do you break out of this cycle and protect your net worth? Rule number 1, never buy the hype. When every news outlet, influencer, and coworker is telling you a stock is guaranteed to go to the moon, smart money's already out. They're distributing their shares to you. The party's over. Rule number 2, welcome to the red days. A market crash isn't a tragedy. It's a clearance sale on prime assets. When the crowd's screaming in panic, that is your signal to hunt for value. Rule number 3, stop trading with your heartbeat and start trading with your math. Wall Street relies on your fear and your greed to take your money. When you master your emotions, you master the market. Stop being the liquidity for institutional traps. If you're ready to stop panic selling, ignore the noise, and build real undeniable wealth, hit that follow and subscribe button and join the elite. Drop a comment down below letting me know which phase of the market cycle you are preparing for now. Welcome to the Turbo Investor. Let's get to work.